Hello and welcome back to Miss Finance. Today we're going to have a look at how you can pay off your mortgage in 5 to 10 years. Now if you scour the internet, you'll find out there's a lot of YouTube videos coming from the US where people have paid off the mortgage really fast. But unfortunately there are rules that apply to the UK and the US that differ, so a lot of those videos don't apply here unfortunately. So my aim today is to inspire you and to show you that it's entirely possible to pay off your mortgage in 5 to 10 years, and I'm going to show you exactly how you can do that. The aim here is to make sure that you're able to achieve financial freedom as quickly as possible. So let's dive in. Now, there are 3 different elements to every mortgage. You've got the principal, which is the amount that you initially borrow up front. So say if you buy a house for £150,000, the principal will be the £150,000. Now, in order to make this viable for the bank, they have to have something back. So they apply interest to a mortgage, and that's what you're paying every month. So what you're paying is the mortgage principal plus interest every month. And that's how mortgages are worked out. And that might be over a lifespan of 5 years, 10 years, 15 years, all the way up to 30 years in some cases. Now, what a lot of people don't understand or that they're not aware of is when you first take out a mortgage, the actual amount of interest that you're paying in the beginning is a lot more than the interest that you're going to be paying later on down the line. So the interest that you pay in year 1 will be slightly higher than what you pay in year 2, year 3, and year 4. And that's because banks are smart, and what they're trying to do there is ensure that they get something back for lending you that money, because they're aware that obviously individuals can pay off a mortgage earlier. So if they were to apply the interest at a fixed rate across the board, the same amount from day 1 all the way up to when you're paying in year 10, they want to make sure that they are getting something back for loaning you that money. And you'll see this if you actually look at your mortgage statement. You'll see that the amount of interest that you paid 5 years ago was a lot more than what you're paying today. So the aim of the game is to hopefully reduce the amount of interest that you're paying in the long term, because you're not going to reduce the amount of principal that you have to pay. That'll always be there, and the only other way to pay that off is to either sell the house or change your mortgage plan onto another one. Now, a mortgage is always going to be one of the largest amounts of debt that you owe, and most people will have a mortgage throughout their life. If we can reduce that somehow, then that's obviously going to benefit us. Now, over time, hopefully, the value of your house is going to appreciate in value, meaning that it's going to go up in value. So if we look at the concept of cash in hand now, cash in your hand today is worth more than it is in the future. So by that, because currently the mortgage that you owe is a liability to the bank, if you reduce that liability early on and the appreciation on the house is going up over time, then if you were to pay off the mortgage early or as earlier as you can, then you're going to get more benefit out of that than if you were to continue paying for a longer term. So it's always worth paying off your mortgage early. So let's have a look at exactly what you can do. Now, there are different rules. So if you have a variable mortgage versus a fixed rate mortgage, there are specific terms in there that state that you can only pay a certain amount above the amount that you should be paying in order to pay off the mortgage early. So in a lot of cases, fixed rate mortgages, you can pay up to 10% off the value of the mortgage every year. You need to have a look at the terms and conditions of your own mortgage, but that does mean that you can pay an additional 10% towards that mortgage every year. So you could either do that in the form of a lump sum, or you could do it by adding an additional 10% as an overpayment on what you're currently paying every month. It's very important to understand the terms and conditions of your own mortgage, because you certainly don't want to go down the route of getting penalised and having to pay additional fees because you've gone over and above the amount that you're allowed to pay. So it's definitely worth consideration. Now, if you're not on a fixed rate mortgage, then you really need to pay attention to the terms more so than if you were on a fixed, because the base rate of the Bank in England does go up and down every month. So you've got to be careful over how much you're paying to make sure that you stick within the percentage that they've allowed you to pay on top. So this can be a bit more trickier with a variable rate mortgage because of that reason. Now, an easy way of you working out that 10% if you take that total value and times it by 1.1 in your calculator, and that'll give you how much you should be paying. Now, if you want to work out how much that's going to actually save you over the term of your mortgage, if we have a look at examples, so if you had a mortgage debt of £150,000 over 25 years, and that was a repayment mortgage, so not an interest only, a repayment mortgage at 3% interest per year, if you made an additional payments of 10% annually, so where you normally pay £711 per month, but you pay an additional £74 per month on top, then you'll actually save yourself £10,418 in interest alone. And that means that you'll actually be able to pay off the debt in full 3 years and 2 months earlier. And if you want to look at that year by year, say in year 1 you've got, we'll call it year 0, you have £150,000 outstanding. By year 5, without the overpayment, you'd have £128,254 outstanding versus £121,083 outstanding by year 5. And in year 10, you'd have £102,996 outstanding without any overpayment versus £89,138 with an overpayment. So you can see that it's very beneficial for you to make those overpayments if you can, of course, afford that. So let's have a look at another example. So if you took out a £100,000 mortgage over a term of 20 years under a repayment mortgage, so again, not interest only, repayment so if that was 4%, a 4% interest rate that was fixed over the 20 years, then you'd normally pay about £606 per month towards that mortgage. So if you regularly overpay £67 on top of that every single month, then you'd be mortgage free 2 years and 1 month earlier than what you would have been if you didn't make those overpayments. So if we have a look at the 5-year mark, without the overpayment, you'd still owe £81,917 versus £77,138 with an overpayment. And if we look at the 10-year mark, you'd actually owe £59,843 versus £50,592 with the overpayment. So you can see it's definitely worth your while to make these overpayments. Now, the other thing that you can do is if you're in a job where regularly at the year end you receive a bonus at, say, April or December, then it's always worth considering if that money should be sat in the bank gaining interest, or if again you can pay off a lump sum underneath the 10% or however much your mortgage rate allows you to every single year to pay off early, because then again that will reduce the amount of mortgage repayments that you have to make and might save you a lot of interest. Now, the other route you can go down is obviously making the money work for you in order to pay off your mortgage. So there are other alternatives you can look into, such as investing in a company or investing in a cash ISA where they do the work for you and you get a bit of a higher interest rate than what you would normally do having that money in the bank, and then using that to then pay off the mortgage. Now, if you want to work out for yourself how much you could save in interest over the term of your mortgage, then you can always use Money Saving Expert, where I'll leave a link below in the description for you so you can calculate for yourself what overpaying by 10% would save you in the long term. Now, if you're currently on a variable rate mortgage, you can always start looking after 5 or 10 years to switch your mortgage to a fixed rate so that you know exactly how much you're paying every month and whether you can make these repayments on top. So that's something to watch out for. It's just having a look around and seeing if there is a different mortgage rate that could work better for you, that would enable you to pay off your mortgage earlier. So that's definitely worth looking at, and definitely after the 5-year mark, and have a look at other ways that you personally can make overpayments towards that mortgage, whether you have to move things around or have a look at what you're spending to make sure that you can make those overpayments. And that's definitely worth looking into. So please do hit that like button if you enjoyed this content or if it helped you in any way, and if you're feeling very generous, please do subscribe. Otherwise, I shall see you on the next video.